Explainer 1, the Fed's dual mandate. Hi, John Rothfield with Derivative Logic. We start our series of macro explainers at the most obvious intersection point between economic data and interest rates that borrowers face. This is the Federal Reserve Reform Act of 1977, where the so-called dual mandate was born. The Federal Reserve was founded in 1913, but it took decades and a series of events before Congress decided to establish explicit goals for Fed policy as it related to the economy. In 1971, under President Nixon, the US terminated the direct convertibility of the US dollar to gold, thus fully transitioning the nation to an unanchored or so-called fiat currency system. By then, the US was in the midst of an episode that became known as the Great Inflation, originating from a combination of supply shocks, deficit spending, and easy money. During this period, high inflation and unemployment were positively correlated, i.e. stagflation. The Federal Reserve Reform Act of 1977 explicitly directed the Fed to maintain long-run growth of the money and credit aggregates that would be commensurate with two things: maximum employment and stable prices. Here, I will focus on the stable prices mandate. Paul Volcker, appointed to the Fed chair from 1979 to 1987, had a difficult time wrestling with the high inflation regime that he had inherited, his initial focus being on free reserves in the system rather than with the price of money, resulting in high and volatile interest rates. By the time he handed over to Alan Greenspan in August 1987, inflation was lower but not completely tamed. 2 months later, the new Fed chair's efforts to address inflated market valuations and consumer prices led to the so-called Black Monday stock crash of 19 October 1987, when the Dow fell 23% in one day. But it wasn't until 2 July 1996, the Fed meeting, that a meaningful discussion occurred around putting a number to the achievement of stable prices, and they settled on 2%, sufficiently different to zero so as to reduce the prospect for a bout of deflation, but not high enough to alter business and household spending decisions. By the way, some peer countries had gotten to this point sooner. Between 1990 and 1993, the central banks of New Zealand, Canada, the UK, Australia, and Sweden all had adopted formal inflation targets that had centered on a number like 2%. But the US was far from ready to go public, and the minutes of that 1996 meeting made no reference to the discussion of a target. Chair Greenspan even warned that if the 2% inflation target gets out of this room, it is going to create more problems for us than I think any of you might anticipate. For years afterwards, Greenspan's Fed relied on the chair's discretion rather than formal rules, a period known with some irony as the Greenspan Standard. In 2003, then Fed Governor Ben Bernanke cautiously introduced the topic in a 2003 speech, suggesting that there existed an optimal long-run inflation rate, or OLIR, of about 2%. He cited several studies that found that 2% was the lowest inflation rate for which the risk of Fed funds hitting zero and their zero lower bound appeared to be, quote, acceptably small. Nothing was formalized until after the Great Recession of 2008-2009, though, during which time consumer price inflation had fallen to a low of negative 2%. The bout of deflation that the Fed had feared and in which Japan had persisted for 2 decades and counting. Under Ben Bernanke, who had become chair by then, the Fed finally saw fit in January 2012 to introduce a formal 2% inflation target, with its statement on longer run goals and monetary policy strategy. There is one more twist, however, in the tail for inflation targeting. In the 2010s, the Fed got stuck at zero interest rate for a long time, a period that became known alternately in the markets as secular stagnation or simply the new normal. Just to get inflation anywhere near 2%, they had done 3 rounds of massive balance sheet expansion known as quantitative easing. Thus, in a 2020 update to its goal statement, the Fed dabbled in what they called flexible average inflation targeting, or FAIT, simply known as FATE, allowing for periods of sustained above target inflation to compensate for long periods below. No sooner had they incorporated FATE into its goals, however, that the pandemic produced a sustained burst of inflation that the Fed was slow to react to. Thus, 5 years later, FATE was ditched, and we were left again with the 2% point target. In our next segment, we will discuss the 2 candidates for the Fed's inflation rate target, the Consumer Price Index and the Price Index for Personal Consumption Expenditures, known colloquially as the PCE deflator. Please let us know if you have topics that we should cover in our Explainer series.